Hello, my name's AJ Balama. I'm a registered investment advisor with Capital Securities Management, and I'm part of the team that advises on your company's retirement plan. Today's topic is on traditional retirement contributions and the many tax benefits you get for putting money into your 401k.
So, a key idea that needs to be understood when dealing with your retirement plan is how the money you're saving is being taxed by the government.
The single most noticeable and important benefit of a traditional 401k contribution is that it lowers your AGI, or adjusted gross income. In other words, if you made $50,000 in a given year and you put 15% of your income, that's $7,500, into your 401k, you only get taxed on $42,500. This makes your tax bill cheaper at the end of the year. Assuming you're filing as a single in this scenario, you would save a whopping $1,290 in taxes. At the end of the day, you get to take money from Uncle Sam and put it to work for your retirement. But you don't get to keep those taxes forever. The government labels the 401k as a tax-deferred account, the key word here being deferred. Tax-deferred essentially means that you don't have to pay any taxes on your contributions or the growth of those contributions like you normally would. Instead of paying taxes now, you pay taxes when you withdraw money from the account. The withdrawal is taxed as normal income, and you are taxed at your incremental tax bracket. This is helpful for two reasons. One, you get unhindered growth in your investments. Imagine you start contributing to your 401k at age 25. You'll have upwards of 45 years before you have to pay any taxes on your investments. Secondly, when you do take the withdrawals and have to pay taxes, you'll probably be in a lower tax bracket since you should be retired. As a retiree, you're probably not going to be earning as much as you are today. To illustrate the difference tax-deferred growth can make, you can go online and look at a bunch of different calculators. The calculator I found is from CalcXML. So let's assume we have nothing saved, and we put in $7,500 per year for 30 years, while assuming 7% growth rate and a 25% marginal federal tax bracket. At the end of this simulation, you would have around $758,000 in a tax-deferred account versus roughly $548,000 in a taxable account. That's more than a $210,000 difference. That's huge. This is the power of tax-deferred growth. Which dollar figure would you rather have? But be warned, like all good things, there's a catch. You need to hold the money in your account until you're at least 59 and a half. If you don't, if you take out money before 59 and a half, you have to pay normal taxes plus a 10% early withdrawal penalty. However, if you need money in a crunch, 401k plans offer a unique solution. Instead of pulling money out of your account, you can actually borrow up to half of your account value. This is a really useful feature because you're borrowing from yourself. Unlike borrowing from a bank who charges you interest that you never get back, when you borrow from your 401k, you pay yourself back the interest. So you're actually still saving for retirement even when you take out a loan. At the end of the day, your 401k is for retirement. And as long as you treat it that way and you don't take out money before 59 and a half, the tax-deferred status can be a huge benefit to you. So, as a recap, some important things to remember about your 401k contributions are 1. They'll lower your adjusted gross income and what you pay in taxes at the end of the year. 2. They'll grow tax-deferred. This allows for unhindered growth for many years. Remember, you won't pay any taxes now. You'll pay taxes when you retire. And lastly, 3, you shouldn't take out any money from your 401k until you're at least 59 and a half. If you do, you'll get taxed at your normal tax bracket plus an additional 10% penalty.